Welcome back to Talk Tickers. It is Wednesday, February 4th, 2026. I hope you've had your coffee, maybe a double shot, because we have a monster session ahead of us.
We certainly do.
Today, we are deep diving into the ticker that literally moves the world, UBR.
It's the big one. They dropped their Q4 earnings pre-market today. And honestly, if you were just scanning the headlines on your phone, while brushing your teeth, you might be incredibly confused right now.
Confused is putting it lightly. We are seeing a textbook case of good news is bad news.
Yeah.
On paper, Uber posted just a record-breaking quarter. Revenue is up, bookings are up, cash flow is massive. But if you look at the terminal right now, the market is absolutely punishing them.
It is ugly out there. The stock closed today at $73.92.
Wow.
That's down roughly 5.15%. But, the price isn't even the main story. It's the conviction behind the sell-off. We saw a massive volume spike.
Massive.
Over 62 million shares traded.
Which is huge. That is, triple their 3-month average?
Precisely. This wasn't just retail traders panicking because a line went down. This was institutional rotation. The big money, the pension funds, the hedge funds, they are moving.
So that's the central mystery we need to solve today. Uber just posted 20% revenue growth and is printing cash like a central bank. So why did investors hit the eject button? Is it the guidance? Or is there a creeping existential fear about how much this Robotaxi war is actually going to cost them?
That is the multi-billion-dollar question. And to understand the drop, we have to look past the top-line glitter and see what's happening in the kind of the plumbing of the business.
Okay.
Because the narrative on Uber is shifting. For the last 2 years, the story was growth at all costs. Now, the market is folding its arms and saying, okay, show me the margin durability.
All right, so before we get into the psychology of the market, let's unpack the actual cold, hard numbers.
Yeah.
Let's do the beat before we get to the miss. What went right in Q4?
The scale of this business just continues to be mind-boggling. Revenue came in at $14.37 billion.
Which beat consensus.
Beat consensus, and it's up 20% year over year. Gross bookings, that's the total dollar value of every ride, every burrito, every package, hit $54.14 billion. Up 22%.
And just to contextualize that scale, they mentioned a run rate stat that really stuck out to me. They're now at a 15 billion annual trip run rate.
That breaks down to about 40 million trips every single day.
40 million.
Yeah.
It's hard to wrap your head around that level of logistical complexity. That's not just an app anymore. That's global infrastructure.
It is. And the engine is firing on all cylinders. Delivery is actually outgrowing mobility slightly right now. 26% growth versus 20%.
What about freight?
Freight is still the laggard, basically flat, but let's be honest, nobody is buying Uber for the freight business right now. It's a rounding error compared to the core platform.
Fair enough. But here is where it gets murky. The profitability. We saw a miss here, correct?
Yeah, we did. And in this market environment where, valuations are stretched, you just cannot miss on earnings per share. Non-GAAP EPS, that's their adjusted earnings, came in at 71 cents.
And the street wanted?
The street was looking for 79, so that's an 8-cent miss.
And the GAAP number, the strict accounting number, that was even lower.
Much lower. GAAP EPS was only 14 cents. Now, before everyone panics, to be fair to management, we have to put a massive asterisk there.
Okay.
That number was just crushed by a $1.6 billion pre-tax headwind from revaluing their equity investments.
Can you translate that for us? What does revaluing equity investments actually mean here?
Sure. Uber isn't just a rideshare company. They're also an investment firm of sorts. They own stakes in other companies like Aurora or Grab in Southeast Asia or Didi.
Right.
Every quarter, they have to look at the market value of those stocks they own. If those stocks go down, Uber has to record that drop as a loss on their own books, even if it doesn't affect their day-to-day operations.
So the company's Uber invested in lost value, so Uber had to write that down.
Exactly. It's a paper loss, not an operating loss. It doesn't mean the Uber business lost money selling rides. It means their investment portfolio had a bad quarter.
Okay, investors usually look past paper losses, but they don't look past cash flow. And the cash flow story seemed incredibly strong.
It was a monster number. Free cash flow for the quarter was $2.8 billion. For the full year of 2025, they generated nearly $10 billion in free cash flow.
$10 billion.
That is up 42% year over year.
So let me get this straight. They generated nearly $10 billion in actual cash, grew revenue 20%, and the stock tanked 5%. Help me bridge that gap. Because if I owned a pizza shop that grew 20% and put cash in my pocket, I'd be throwing a party.
It feels like a disconnect if you're looking backward, but the market trades on the future. The stock price today is the discounted value of what we think happens tomorrow.
And tomorrow doesn't look as good.
Well, the air pocket that caused the sell-off was the guidance for Q1 2026.
Okay, what was the issue with the outlook?
The bookings guidance was solid 52 to 53.5 billion. That implies 17 to 21% growth. That's fine. The problem was the profit outlook.
Let me guess, a little light?
They guided for non-GAAP EPS of 65 to 72 cents. And yeah, the street viewed that as very conservative, maybe even soft.
So investors are worried that the margin expansion story is stalling out.
They're worried the easy money has been made. For the last 2 years, the Uber story has been, we are disciplined, we are cutting costs, margins go up. It was a great story.
And now?
Now, investors are sensing a pivot. They fear Uber is entering a new investment cycle. They see money being poured into positioning for an autonomous vehicle future, and they are worried that the year of efficiency is over and the decade of spending is back.
This transitions us perfectly into the biggest topic of the call, and honestly the biggest topic in transportation right now, the Robotaxi war.
This was the elephant in the room, or maybe the robot in the room.
Right. CEO Dara Khosrowshahi spent a lot of time defending their strategy here. Because the fear, and correct me if I'm wrong, is that Tesla or Waymo or some new player is going to come in with a fleet of robotaxis and just undercut Uber's pricing, basically destroying their business model.
That is the existential bear case. The fear is that Uber is just a middleman, a toll booth. And once the cars drive themselves and are owned by a megacorp like Tesla, you don't need the middleman anymore.
You just use the Tesla app.
You just use the Tesla app. Dara's job on this call was to convince everyone that AVs are a growth driver, not a replacement.
And he had some specific data to back that up, right?
Yeah.
Specifically regarding cities that actually have AVs running right now, San Francisco, Austin, Atlanta. What does the data say?
The data is fascinating because it kind of counteracts the fear. He noted that in those specific cities, overall bookings are accelerating. New users are growing faster than the national average.
So his argument is that AVs bring down the cost of transport. Cheaper rides mean more rides.
Exactly. It expands the total addressable market. If a ride across town costs $30, maybe I take the bus. If an AV does it for $12, maybe I take the AV. Dara is betting that the pie gets so much bigger that it doesn't matter if the slice per ride is smaller.
Okay, so a rising tide lifts all boats. But what about the winner-take-most fear? The idea that whoever owns the hardware wins.
This is where Uber's counter-argument gets sophisticated. They are betting that the future isn't one manufacturer dominating everything. They believe it's going to be a diverse fleet.
You'll have Waymos, Teslas.
You'll have Waymos, you'll have Teslas, you'll have Wabis, maybe some Zooks. And someone needs to aggregate all that supply into one app because a consumer doesn't want to check 5 different apps to get a ride.
They did mention a lot of partners, NVIDIA, Wabi, Avrede, Waymo, but they dropped a metric that I think is the most important number from the entire call regarding AVs.
I think I know the one you're talking about.
They claim that third-party networks like Uber have structurally higher utilization, specifically 30% higher trips per vehicle per day.
That is the key stat. That is the moat.
But I want to drill down on this. Why? Why can Uber keep a robotaxi busier than Waymo can on its own? It seems like a car is a car.
It comes down to what they called the trough theory. This was a key strategic insight. Think about passenger demand. It has massive peaks morning rush hour, evening commute, Friday nights.
You know, when everyone goes to the bar.
Right. But it also has deep troughs.
Like Tuesday at 2 p.m. or Wednesday at 10 a.m.
Exactly. If you were a dedicated passenger network during those times, your demand drops off a cliff. Most cars are just parked.
So Waymo, my very expensive robot, is sitting there burning depreciation but making $0.
Exactly. And depreciation is the killer in the hardware business. But Uber has Uber Eats. They have a delivery network. Dara explained that during those low-demand passenger hours, the trough, they can switch those AVs to doing food delivery or freight.
Oh, that is clever. So the robotaxi drops off a commuter at the office at 9 a.m. and instead of parking, it goes to like Starbucks or Chipotle to pick up delivery orders.
Precisely. That increases the utilization of the asset. And in a high capital business like owning fleets of cars, utilization is everything.
Right.
If Uber can generate revenue 18 hours a day from a car, and a standalone competitor can only generate revenue for 12 hours, Uber wins. That 30% advantage is why they think fleet owners will eventually have to partner with Uber to make the math work.
That makes a lot of sense. It turns the whole super app idea into an operational efficiency engine.
Yeah.
But speaking of math and high capital, we have to talk about the scary part. The reason the stock is down.
Yeah.
Uber's starting to spend real money on this.
They are, and they admitted a change in tone. For years, Uber has been asset light. They don't own the cars, the drivers do. That's why their margins are good.
But that's changing.
Well, on this call, they discussed the deal with Wawabi, which includes an offtake agreement for the first 25,000 vehicles.
I feel like we need to define that. For the listeners who aren't corporate lawyers, what exactly is an offtake agreement?
It's basically a guarantee. It's Uber saying to the manufacturer, if you build these 25,000 robotaxis, we promise to buy the capacity.
So they're guaranteeing the demand.
Right. And in some cases, to get these startups off the ground, Uber might even have to step in and help finance the fleet initially. They're putting their own balance sheet on the line.
To an extent, yes. And this moves them slightly back toward asset-heavy territory.
Yeah.
And Wall Street hates asset-heavy. They want software margins, not hardware depreciation.
They remember the early days when Uber burned billions trying to lease cars to drivers, and it was a disaster.
Management claim these deals have positive unit economics, but the market clearly isn't fully convinced yet. It feels like we're in a transition period where they have to prove the model all over again.
That's the friction. Investors love the $10 billion in cash flow, but they hate the uncertainty of how much of that cash is going to get burned building out this AV future. They're asking, are we going to burn $5 billion to verify this trough theory?
Let's pivot to the core business, because while the robots are the future, the humans are still driving the cars today. And something surprising is happening in the U.S. business. It's accelerating.
It is, and this defies the law of large numbers. Usually when a company gets this big, doing $14 billion, a quarter growth naturally slows down.
But U.S. growth is picking up. Why?
There's a specific hidden driver for this: insurance.
Insurance, usually that's a boring cost center. How is that driving growth?
It was a massive headwind for years. Inflation drove insurance premiums through the roof, which meant Uber had to raise prices for riders just to cover costs. High prices hurt demand.
And now?
But Dara mentioned that insurance costs have finally flipped. Two things. One, tort reform in various states limiting lawsuits. But two, and more importantly, safety tech. The cars are safer, the monitoring is better. He said costs are stabilizing or even coming down.
So if their costs are down, they don't have to raise prices.
Exactly.
Yeah.
They can hold pricing flat. And here is the economics 101 part. When you hold prices flat in an inflationary world where everything else is getting more expensive, your product effectively gets cheaper for the consumer in real terms.
That drives elasticity. If an Uber feels cheaper relative to my paycheck than it did last year, I take more rides.
Precisely. That is driving the acceleration.
That makes sense. And they are locking those people in with memberships. Uber One seems to be a juggernaut.
It's growing 55% year over year. And the cross-selling stats are impressive. 40% of customers now use multiple products. They ride and they eat. Or they eat and they shop for groceries.
Speaking of which, they mentioned new verticals growing, retail and grocery. They even shouted out an exclusive deal with Kohl's in Australia. It seems like the Uber for everything vision is actually materializing.
It increases the stickiness of the platform. Once you are an Uber One member and you use it for rides and tacos and groceries, you are far less likely to switch to Lyft or DoorDash. You are in the ecosystem.
I want to touch on a piece of news that often spooks investors. The CFO is leaving.
Yes. Prashant Mahendra-Rajah is stepping down. He's leaving to serve America.
Which is a very patriotic but slightly vague reason. Usually a CFO departure is a red flag. It makes you wonder, are the books cooked? Is there bad news coming?
That is the typical reflex. When the person in charge of the money leaves, people get nervous. But in this case, the market reaction was pretty muted.
Why do you think that is?
Because the replacement, Balaji Krishnamurthy, is an internal hire. He's been with Dara for a long time. The language around the transition was very seamless.
So it feels less like a rat fleeing a sinking ship.
And more like a genuine personal life choice by Prashant. So yeah, the market seems to have given them a pass on that one.
Let's talk about what they're doing with all that cash. We mentioned the $10 billion in free cash flow. What is the capital allocation strategy?
This is where the tension lies again. Management called the stock really cheap at these levels. They are committing to being aggressive buyers of their own stock.
Buybacks. Everyone loves buybacks. It increases earnings per share.
They do. But They are trying to do two things at once.
Mm-hmm.
They want to buy back stock to juice the EPS, and D, they need to fund this AV CapEx we just talked about.
Can they do both?
With $10 billion a year, yes, mathematically they can, but the market is skeptical of the split focus.
It's an identity crisis.
Exactly. Usually you are either a growth company investing everything back into the business, or you are a value company returning cash to shareholders. Uber is trying to be both, and sometimes that sends a mixed signal.
Are you a tech startup or are you a utility?
Precisely. And right now, with the stock down 5%, the market is saying, we're not sure which one you are, so we're going to discount you until we figure it out.
So what does this all mean for you, the listener? If you're looking at Uber today, you see a company that is dominating its core market, generating massive cash, but facing a massive technological paradigm shift.
I think the key takeaway is that the easy money phase for Uber stock might be paused. The next 12 months are going to be about execution. They have to prove that the asset-light model can survive the transition to asset-heavy autonomous driving.
It's a show-me story again.
It is, but let's not lose sight of the fact that they have 200 million monthly active platform consumers. That is a fortress. It's going to be very hard to dislodge them, even for a robot.
Okay, we have analyzed the past. Let's look at the future. But not the boring consensus estimate future. It is time for our favorite segment.
The lawyers are sweating already. I can hear them pacing.
They sure are. This is the part of the show where we remind you this is not financial advice. We are not financial advisors. Do not trade based on what we say. This is for entertainment purposes only. Treat this like a hedge fund analyst pitching a crazy idea at 2 a.m. in a dive bar.
All right, hit me with it. What is the trade?
Okay, we've been talking about the financialization of the Robotaxi fleet. Dara explicitly compared the future of AVs to the hotel industry.
Right. Marriott manages the brand and the bookings, but they rarely own the actual hotels. A REIT, a real estate investment trust, owns the building and takes the real estate risk.
Exactly. Marriott doesn't want the real estate risk. Uber doesn't want the vehicle depreciation risk. So the trade is the Robotaxi REIT synthetic.
Ooh. Okay, break it down for me. Who is the REIT in this scenario?
The logic is that someone has to own these millions of robotaxis. It's a terrible business for car companies to hold them on their balance sheets, and it's bad for Uber. So a new class of asset owners is going to emerge.
Like fleet management companies.
Exactly. So the trade is you short the OEMs, the traditional car makers who are going to be stuck carrying the depreciation, and you go long on specialized fleet management or leasing financial firms. Or if you want to get really spicy, private credit proxies that lend to these fleets.
You're betting on the landlords of the AV rolling stock.
Correct. But here's the twist. If you can't find a pure play fleet manager, here is the alternative pair trade. You buy Uber and you short a basket of auto insurance carriers.
Short the insurers. Explain that one. That seems counterintuitive.
Think about it. Uber just admitted on the call they are solving the insurance cost problem. They are taking less loss. AVs are theoretically much safer than humans. If accidents go down, what happens to premium?
They collapse.
Exactly. The margins for insurers in the commercial mobility space are about to get squeezed into oblivion by data-driven safety. If there are no accidents, nobody pays high premiums. The safety dividend goes to Uber's bottom line, and the revenue destruction hits the insurance companies.
That is fascinating. It's the safety squeeze.
It's wild, it's plausible, and it is incredibly risky.
I love it. Just don't bet the farm on it.
Never. Okay, let's wrap this up. Recap for the people in the back.
Uber is a cash machine, $10 billion in free cash flow, but it is currently in the penalty box because investors hate uncertainty, and the Robotaxi spend is a big, dark cloud of uncertainty.
The business is scaling. The U.S. is accelerating. But the next 12 months are crucial. They have to navigate this transition from asset light to asset heavy without destroying their balance sheet.
And without spooking the investors who just got comfortable with their profitability.
It's going to be a bumpy ride, but hey, at least they have good shocks.
And 40 million trips a day to figure it out.
That's a wrap for today's deep dive on Uber. Check your own risk tolerance before you do anything. We will be back with another earnings breakdown soon.
Thanks for listening.
Talk Tickers signing off.